Good afternoon, everyone. Welcome to today's market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices: the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we conclude that, we'll take a quick look at the U.S. dollar, see how gold, oil, and silver are behaving, and then from there we'll move on to chart requests. Anyone in here has a chart request, you can add it into just type it into the chat, and I'll go ahead and take a look at it, and when we get a chance, I'll go in and take a look at your charts. It doesn't have to be a stock that you're actively looking to trade or even trading. It could be just a question you have on a chart, or it could be that maybe you're in a stock and you can't figure out if it's time to stop out or to take profits or anything along those lines. Other than that, hope you guys are having a good week, and we'll go ahead and get started. Wes, good to see you in here. We'll take a look at UPS for sure when we get to that part. Shipping, the shipping companies are interesting. Just based off of what's been going on today, or not today, but going on in our general economy. So I will look at UPS for sure. Haven't looked at them in a while. But before that, let's go ahead and get started with the S&P 500 and the ETF SPY. For those of you that are in here, if you like what you see, if you like my analysis on these stocks, or you want more information on how I trade, you can always find me on Twitter at StockDarts, also on StockTwits at the same name. You can also go to YouTube and look for StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content. Typically on Mondays I'll put up a couple of trade ideas or names that I'm putting on watch lists and how I'm going to go ahead and trade that particular week. Every Monday I usually give you a good idea of what kind of game plan I have for the week and what I'm looking to happen, and then typically I'll repost on Wednesdays these market reviews, and if I have a trade idea that comes up any of the other days of the week, I'll put them in there as well. A lot of the stuff on there is free, and it's a good idea for you to go ahead and visit that if you want to see more of how I analyze the markets, or how I go ahead and act on the information we come across on these Wednesday market streams. A lot of times when we discuss the markets on these Wednesday streams, I'll mention the trading strategy, how I want to go ahead and approach it. And if you want more detail on those trading strategies, we'll visit that page, and that's where you'll figure out exactly what types of trades I'm taking and how they align with what exactly I'm seeing in the overall markets. Now, this week I had actually said that I was looking for some short plays because the market was getting a little overextended. On Monday we still looked pretty bullish, but the risk reward just wasn't there, and it was something we've discussed previously over the last few weeks. The market is now starting to reach levels that it really should have a hard time getting through, and the risk reward for the long side is just not there. And so I pointed out a couple areas that I thought were weak. I also tweeted a couple areas yesterday that I thought were weak, which we'll cover when we get to the chart request. I'll give you a better idea of some of the areas that I consider weak and would be the first to kind of come down a bit, and that's what's happened so far, and we'll see how it goes moving forward. But for now, we're finally seeing some selling pressure. Yesterday we had a pretty big bullish engulfing candle, and followed today with a break of the 20-period moving average. And on the S&P 500 particularly, we also lost this broadening wedge that we've been kind of climbing up above, and so it shows that we've seen a direction shift in the short-term price action in the S&P 500, and I think this is something that could persist probably at least until the middle of next week, as we come down and head and figure out some support levels. A bigger picture, this was something that really should have started happening a little bit before. We found what I consider a pretty stable bottom now, and really it comes down to what the S&P 500, or what the stock market in general is going to do over the course of the next several months as we start to open up our economy. And while the Nasdaq actually almost made it all the way back to all-time highs, I think generally speaking, if we look at the markets, it's more likely than not that we're going to enter a trading range now that we have a better idea of how our economy has been impacted by this coronavirus shutdown and this whole pattern of self-isolating and remaining at home. And really what we're doing is at this point is establishing what the top of that range should be. That's an idea that we've discussed over the last few weeks, and I think at this point we've probably come pretty conclusively, hopefully, pointed out that 295 or so is going to be a decent ceiling for the S&P 500. Now, of course, it could happen that we just turn around and come back and test that level again, but it seems to make sense that this is an important area. If we go ahead and look at a weekly chart, and we see exactly the significance of that level, you can see the 294, 295 on the S&P 500 has actually been a pretty critical level all the way back since 2018, right? We had a nice range that we spent basically all of 2018, 2019 in, and last year we started to break out, and the beginning of this year we really took off and made it all the way up to 340 on the S&P 500 before, of course, we basically sliced through all of it with the whole coronavirus and the whole pandemic. We actually were able to come right back in and get back into that range, which I think was a really good turn as far as the price action is concerned, but we've made our way back up to the top of that ceiling. And I think that that's an important level that should act as a barrier for the price action on the S&P 500. Now, as we go through and we take a look at where the NASDAQ stands compared to that level and where the Dow Jones and IWM stand, we'll see that there's a little bit of a disparity right now between the different areas of the market, but I think that's normal when you consider exactly how our market's behaving right now. We actually have a pretty big dichotomy right now and a pretty big split between two types of stocks in our market. One are the names that actually have not been impacted very much by people staying at home and working from home or shopping from home. Stuff like Amazon, stuff like Zoom, stuff like Citrix, which we've covered ad nauseum. We've covered those names to death over the last month. But there's generally speaking, there's a nice little area of the market that actually has survived because it hasn't really been impacted. But on the other end, there's another side of this market that's been impacted very severely. Because they've been closed for a month and a half, 2 months now, and likely might remain closed for another 2 or 3 months. And even when they do open, they're going to have very limited business. And so that has kind of played out when you look at the major market indices. The tech names, which in particular are pretty overweighted toward names that have behaved well during this time, and so the Qs are doing really well. Some of the small caps and some of the Dow Jones industrial names have struggled a bit, and you'll see that as we go through their charts, that the Dow Jones index has been weaker, and the Russell 2000 and IWM has been the weakest. And so that's a pattern that's going to continue to play out as we move forward this year. And I think that's something that we've really kind of honed in on in my web page and in these streams, is to take advantage of that. And that's something I think is going to continue. Despite the fact that we might open up, even if we open up next week, there's still going to be names that are going to struggle despite the fact that they're finally open. Movie theaters are still going to struggle. Maybe they'll have an initial surge of people to come in, but generally speaking, they're still going to struggle. Cruise ships might get some people that initially book because just the excitement of getting back outside and being brave enough to say that you're going to go ahead and get on a cruise. But as we move forward, they're probably going to still struggle to maintain bookings throughout the next several months, and it's going to be the same with airlines. We're going to slowly trickle back and get back to normal, but that's not going to be something that's going to happen convincingly until we have a vaccine and until people are more confident in their ability to go out into public. And so a lot of those same names that are struggling now, yes, they'll finally start to get some commerce and get some people to come in and use their products or their services, but it's not going to be the same way that it was last year, and it's going to be something that's going to take a while to get back to normal. And so those names, I think, are still going to struggle, and I think are still going to be the weaker section of the market. So that's one of the things that you definitely want to focus on right now, is understanding this big shift between, or this big split between different types of areas in this market. And, at the moment, what we see on an index isn't necessarily what we're going to see in individual names. And as a matter of fact, what we see on one index is not what we're going to see on any of the other indices. So it's important that you understand what that split is and how you want to go ahead and approach it and how you want to go ahead and trade it. Some people I've seen still want to go ahead and try to play the bottoms on hotels or on cruise ships or on oil names. And while I'm not going to go ahead and say you can't catch a bottom on those types of names, me personally, I find that it's more productive for me to go ahead and focus on the names that I know are going to do well and aren't going to get hit very hard with overnight news and kind of cause me to stop out of a stock that maybe I don't trust as much. So the S&P 500, in my mind, of the four indices, is the biggest, is kind of the best aggregate of the entire market, and is the one that's giving us the best picture of what the overall market is doing. And really, what we're doing right now is we've kind of made our way back into that range, and it looks like it's going to be likely that we spend a good amount of the next couple of months in this trading range. We might try to break past 295 at a certain point, but more likely than not, we'll come right back in and trade within it. And I think at this point, we maybe have a good ceiling identified, but we definitely have a good floor identified. I think at this point, obviously 229, the lows that we had earlier this year are a really good floor that we can probably expect price action to stay inside of, and probably we'll find that 255 or so will also be a level of support that's going to hold the market up, and we're more likely than not going to stay within a range between those. And the good thing about that is, range-bound markets aren't as easy to trade as markets that are steadily climbing upwards, but they're also still much easier to trade than markets that are in a wild, volatile state like what we saw through March and the end of February. And as long as you understand what the range is, well, you can go ahead and benefit from that, because you can just go ahead and trade. You understand where to take profits. You understand where to go ahead and enter. And I think that's where we stand right now. If you're looking to trade, you probably don't want to buy too many breakout trades right now, and you probably don't want to try to short breakdowns at lows. What you want to do right now is play the range. So you want to make sure that you buy value as we hit support levels, and you want to short as we hit resistance areas and you start to see a reaction or a rollover in the market. And so that's kind of the idea of how you want to approach the market right now. Now, just looking at the S&P 500 and SPY and see what we can figure out from here, you'll see, again, we had this nice broadening wedge. You can see this double tap of 295 showing that we were really struggling to break through that level, just below the 200 pair moving average. And we finally had a break of the 20 pair moving average and this ascending trend line. So typically in this sort of price behavior, in this sort of pattern, the next step is a retest of this 50 pair moving average and probably a retest of this area around 274. And I would imagine that's the next step on the S&P 500 is we come right back down and test that level. A lot of times when you have these sort of rising channels or these rising slopes, when you get the breakdown, you'll come down, maybe have another red candle or two, and then you'll come up and retest that breakdown point. And that's really the critical part, is what happens as we test that breakdown. Sometimes you got to move right back through it and back towards the recent highs, and other times that's where you get the real strong move back to the downside. Sometimes you actually get the strong move straight off of the breakdown, but with the amount of bullishness that we've seen in the stock market over the last month, I don't expect this to be a slice all the way down through these levels. I expect buyers to try to support and try to step up and buy here, whether it's the end of today or whether it's starting tomorrow or the day after. But at some point in the near future, between the level that we're at now and this 273, we should get buyers to step in and support price, because that's what's been happening really since all the way back in mid-March, but more clearly back here in April when we started kind of rising through this channel. Every time we have a red candle, it's bought up pretty quickly. And this is the first time really that we start to see some selling pressure that's maybe followed through with the second day. And if we get a third day of follow through, then we should make our way right back down to this, like I said, 273 level, 274. And at that point, we should expect to find some buyers. And that'll really be the key, is do we hold up at this 273? Do we roll over when we hit 284 again? And then from there, we'll see what happens next. But as far as from here to next Wednesday, we're likely going to find support somewhere before or around this 50-pair moving average. And then from there, we'll come back up and probably test the 20 and test this breakdown point again. And then that'll be really the issue, is whether we can hold above this 273 and then what happens at 284. And I think those are the two key levels you really want to watch in the S&P 500. And, at this point, my suspicion is we'll come back and we'll test down here, come up and retest, and then probably fail to make our way back up to 293. And then it'll be the subsequent test of maybe 274 that'll be more critical. Even if we break down and lose the 50-pair moving average, I think overall we're in a state right now where the market is trading sideways, and as long as we don't come all the way down and lose 255, I think it's not really the end of the world. And I think if anything, it'll give us a chance to have some of these charts reset. We've had a lot of strong names that have gone up pretty strongly recently and are now at pretty good levels of resistance, and have made it harder for traders to go ahead and enter to the long side because so many names are extended and really don't offer good risk reward. On the opposite end of that, of course, there are weaker names that are still struggling. And if we do have an extended sell-off here, those names could end up having a lot of damage done to their charts. And again, we'll look at some of those names as we go ahead and go into the chart request area portion of today's show. All right, now let's look at some less likely scenarios, and that would be what happens if we completely slice through 273 and through the 50-pair moving average. Well, like I said, the most likely next stopping point the major stopping point is 255. Maybe we get a little bit of buying somewhere here around 260, but that would be the area really to start focusing on if we slice through all of that. Now that would not be a good sign. If from here to next Wednesday we're already down in the 250s, that's actually a pretty quick move and a very big shift in market sentiment. It could happen. I don't think it's as likely a scenario as us finding support and bouncing between these two moving averages, but it is a potential scenario. And if that's the case, we want to see 255 hold. I think even if we do slice that quickly down to that level, the 255 will still be a decent area to look at buying the dip, but we would definitely have to be a lot more cautious about waiting for support to show up and to see candles giving us a reversal pattern showing the buyers step in. Now, the other not so likely scenario that we want to keep in mind is what happens if we buy up off of today and we kind of close right back at the 20 per moving average and we make another run at 295. Well, chances are we'll probably try to push through that and hit the 200 per moving average, but I won't be one of the people looking to buy that. I think, again, the upside at this point is pretty limited, and I don't think the risk reward is worth it if we continue to push upwards through this 295 area and maybe even up to 300. I consider that to be a pretty strong wall of resistance and one that I don't think we really are ready to pass or trade through. That doesn't mean I'm just going to short randomly because I don't think the market belongs in its area. I'm still going to look for actionable triggers that give me a good trade setup. But generally speaking, I don't think it's worth it to try to buy breakout in this 295 to 300 area until we see a lot more price action to kind of fill out and we see new buyers step in and we see a much better buying pattern develop than what we've seen so far. When you have this kind of rising wedge coming up into resistance on declining volume, it all reeks to me of a market that's starting to get tired and looks to kind of want to turn down and head lower. And that's how I've been kind of that's how I've kind of prepared for it this week. And how I've looked for the trades that I'm looking for. So if we do, for whatever reason, rally right back up to 295, I likely will not be too involved in buying stocks at that point. And I'll kind of wait and see another reversal pattern or look for another reversal pattern before I go ahead and try to take some more short plays. Now, if we look at the NASDAQ, we'll see a little bit of a different picture. And again, you'll see the relative strength of tech names in the tech area compared to the S&P 500. So first thing we want to do is look at the weekly chart. And you take a look at this. So this is the level that would be kind of the same as the 295 on the S&P 500. And you can see the NASDAQ is way above it, right? So this range that we spent 2018 and 2019 in, you know, the NASDAQ has held up above it for pretty much for most of it. Even when we did slice down, we didn't come all the way down to the lows. We just kind of made our way to the middle of the range. We made our way back up, and amazingly, the NASDAQ actually almost filled a pretty important gap over the last couple of days and is very close to all-time highs. So clearly, this is the area that's been affected the least by the market. This is, again, not something new to any of you guys that follow us regularly. This is something that we've been focusing on since the beginning of March. You go back to my Patreon page and you take a look at some of the articles I posted in early March, and the first thing we did was focus on tech names that would be insulated from this coronavirus shutdown. And a lot of those names have been what has carried the market upwards. You take a look at stuff like Amazon, which I only wrote about for like 3 or 4 weeks in a row. You know, and they've been basically at new all-time highs and been holding up steady at highs. You have stuff like Netflix, which again is benefiting from people staying at home. You have stuff like Zoom and Citrix, which of course are online meeting tools. And they continue to outperform the market as well, and they continue to hold up very well. And, you know, this is just a little subset of exactly why this market is doing so strongly. Even stuff like Facebook, Google, and Apple just holding up very strongly and have made their way back up towards highs. And generally speaking, have held the Qs up at a point that's even, you know, stronger relative to the market, right? So clearly, tech is the area you want to focus on if you're looking to trade to the long side, and is the kind of the easiest trade to take right now. Now, that being said, again, was the risk reward worth it to try to go long over the last couple of days, even as we accelerated upwards? No. At this point, what are you looking for? You're looking for maybe 3, 4, 5 points of upside, and what's your downside? You know, all the way back down into the low 200s, and you're going to see that's mirrored on all those charts that I just pointed out. Trying to go long right now, if you're not a day trader, you're not someone that's trading 1 or 2 days swing trades, the risk reward's just not there for you if you're looking at any of those charts that I just pointed out. As much as I like all of those charts, the trade for them was made a while ago. And until they pull back to levels of support, it's going to be hard to recommend going long any of those names, and it's going to be the same thing with the Qs. We need to see a reset here of price action. We need to see more sellers come in and force the buyers to kind of give up their shares. That way new buyers can come in and step up and support whatever level they consider to be value. And at that point we can start looking at maybe buying again once we start to figure out what the new level of support is and where buyers are willing to step in and start supporting the price action again. So as we can see, despite the fact that the NASDAQ, relatively speaking, has been stronger than the S&P 500, a lot of the price patterns are still the same, right? We still got this ascending channel on descending volume. We haven't broken the bottom of it because, again, the Qs are still strong. While the S&P 500 was maybe going to come down to a horizontal level of support, I think with the Qs, because they're still stronger, they might hold up somewhere around the bottom of this channel. They're not going to probably make it all the way back to the 50-period moving average. We're more likely than not going to find support somewhere in this mid 213 to 209 area. Somewhere along the lines of this channel, we'll find support. It doesn't have to be the horizontal, it doesn't have to be the rising trend line. It could be that we end up finding a horizontal level of support, maybe down here around 211, or maybe all the way down here. If this will let me grab my trend line, yeah. It might even be something along these lines. Now, again, I think this is a pretty drastic drop on the Qs when you look at what the S&P 500 was going to do, but this gives you a good idea of what you can expect out of the NASDAQ. Either we maybe find some support at 211 or down here around 206, or we continue to maintain this trajectory. Because the Qs are the strongest, they're most likely going to be the ones that find the support more quickly than the other three indices, and are the ones that are more likely to kind of maintain this pattern as we see how we're going to correct over the course of the next couple of weeks. I think at this point, if you're looking for a signal to the downside, you're probably better off looking at maybe IWM or the S&P 500 or the Dow Jones. If you're looking for a signal to the upside, the Qs are the place to be, but I would not really consider them the idea or the ideal way of looking for weakness in the market, because they're going to hold up better than the others. So if you're looking to figure out just how far this market's going to go down, the other indices are going to breach their levels of support before the Qs do. So in my mind, what you want to do is, if we do recover and start bouncing, then the Qs are going to be the ones that are going to come up and finally fill this gap that they came so close to filling. And they're going to be the ones that you'll see as far as a leader to the upside. But they definitely won't be a leader to the downside. If anything, they're going to fight all of whatever we retrace over the next few days. The NASDAQ is going to fight it tooth and nail and try to stay within the range that it's trading. So for now, I'm not looking at them as far as trying to figure out where they find support. I'm going to look at the other indices more for support levels, and then once we do start to bounce, then I'll look back at the NASDAQ and see how those tech names are behaving and see whether they're moving forward through breakouts. That's going to be one of the key tells for us, is if the NASDAQ starts breaking through levels of resistance as it starts to push upwards, then we can maybe expect the other indices to do so, and maybe not. Maybe we won't get a rollover even further down. But if the NASDAQ, once we do find bouncing, or we find buying and we start to bounce, if we see the NASDAQ stall out, and we see something like this start to develop, then we can expect the other indices to likely break down below whatever levels they're holding. But again, that's something to look at probably more next week than what we're going to look at this week. Now, key levels to keep an eye on. Again, I think I already pointed out all the support levels. This is a key area here, like 200, 201. As long as we're above that, I think it's pretty healthy. And even if we do slice all the way down to that level, I think that's really the strong buying spot here. It kind of aligns with the top of the range that we spent the last couple of years in. And again, it's a 200-period moving average is the 50, which is now starting to turn back up. And that should be a good intermediate level of support, and one of the longer-term ones that we can maybe focus on and hope that we hold over the next couple of months. I think as long as we hold above that, obviously that means that there's very little chance that we come back and print new lows. And despite the fact that we will at some point correct pretty sharply, as long as we can kind of stay above that, I think we're fine. Now, if you look at the Dow Jones again, a little bit weaker. Definitely not quite in the same place as the Qs. You can see, like the S&P 500, we've already lost this ascending channel. Also, surprisingly, we're struggling already to hold above this 233 level. Now again, this white dotted line that you've seen across the board here, that to me, for those of you that maybe are new here, this is an important turning point in the coronavirus pandemic, because back around March 11th, March 12th, that's when the NBA decided to postpone their season, which again, all the other major sports followed through, and not only them, but a lot of major businesses also followed and decided to shut down their doors as well. And that's when we really got into this idea of closing down business and making sure we stayed at home. And that has been a critical area as far as the market is concerned that we need to get back above. You can see it was kind of an important turning point here. We had big, wide candles until we broke past that. All of a sudden, we started to trend in these nice little low volatility candles. There was a big shift in price character once we were able to change that. The S&P 500 is holding pretty well above it, and that's going to be what is potentially our support level. You can see the Qs. Whoops, put an extra Q in there. You can see the Qs left that level in the dust, and it's nowhere near any point of contention right now. But the Dow Jones, it's actually kind of important right now. And we're actually starting to lose it, right? So again, like I said before, it shows that the Dow Jones components are struggling. And of course, remember, Boeing is one of its components, and Caterpillar and a few others that have been kind of struggling to really hold up in this kind of market. And that has led the Dow to be a little bit weaker compared to some of its other peers. You can see that we had a pretty big breakdown of that channel. We're already trying to test this horizontal support, and more likely than not, because of the weakness of the Dow, we're going to push through it, and we're going to hit the 50-pair moving average and likely push through that as well. Now, the key here in the Dow Jones is that we don't accelerate through some of these levels, right? We're going to go through them, but as long as we don't continue to gain volatility and really start to speed up to the downside, what we don't want is a return to this sort of price action, right? Again, you'll notice, just like on the S&P 500, anything below this white dotted line, we've got these really big candles, right? Elevated volatility, a lot of swings back and forth. Once we were able to trade above it, look how small the candles got. A lot of little dojis, a lot of little price action just slowly climbing upwards. And then all of a sudden, we started to get volatility and to increase again, right? If we continue to head below this dotted line, are we going to see a return to this volatility that we had before? If so, there's a decent chance that we're going to make our way all the way back down to 214, 213, and hopefully not any lower than that. But what we want right now is we don't want that. We want us to, if we do pull back, we want it to be in an orderly manner. Yes, maybe we lose the 50-pair moving average and we come back and we test some of this area here between 220 and about 215. But if we could do so with smaller red candles and a couple of buying in between, then it'll show that the market's just kind of retracing and establishing what the range is, and maybe coming back and testing the bottom of the range, but not in one quick move, right? And if that's the case, then maybe it's not so bad compared to what we had before. So that's one of the keys to look at. Now, just like the S&P 500, we probably will find some buyers to step in because, again, the buyers have been slowly supporting price action over the last month and a half. If we do find buyers to step up, well, in this particular case, the retest of this breakdown is pretty important, because if we fail that breakdown, then we're going to keep ourselves below a pretty important technical level, and that means that we're going to be backfilling again into the low 220s and into the 215s, 210 area, which is obviously not a good place to be. You saw with the Qs and with the S&P 500, there's more room to fall back and still maintain a pretty positive price action. In the case of the Dow Jones, there's not quite as much room. There is room, so we could fall back all the way down to 215 and still be in a relatively healthy market compared to what we saw in February and March. But if we start to lose those levels and we start to lose 207, 206, then there's a very good chance that this area in the 190s becomes a strong magnet for price action. So this is one of the areas you want to watch if you're worried about the market and you want your tells to tell you just when we're breaking down. The Dow Jones is one of the areas you want to watch because it is leading to the downside when you compare it to the S&P 500 and the NASDAQ. Then finally we have the small caps in IWM, and they're by far the worst when it comes to this, right? You can see again, we've already lost that white dotted line, which of course is that March 11th date. We've seen volatility already increasing. We've already tested the 50-period moving average, and if you look at the weekly chart, we are nowhere near the range that we spent 2018 and 2019 in. So overall, this is the same case that's pretty much happened throughout the last several years, which is when traders want to leave the market, when risk starts to come up, the first place they leave is the small caps because they tend to be the riskier assets. This market has been one that I think has been characterized by traders having one foot out the door. Every time there's been selling pressure, and I don't just mean this market from the last few months, this market over the last several years has been one where traders are still kind of scarred over what happened in 2007, 2008. And because of that, they've always had one foot out the door. And IWM has really struggled through a good chunks of the last decade every time that we have selling pressure. And of course, this is not going to be any different because this is going to be one of the bigger selling periods that we've had in basically the history of the stock market. And of course, the stock market, and of course, IWM is going to struggle through that. And that's what we can see right now. You can see that we've kind of lost some ground. I was talking to a couple of traders recently and kind of discussing this idea. IWM was picking up strength here towards the end of April. And a lot of small caps and a lot of names like the cruise lines were as well. And in my mind, I took that as my interpretation of that price action was that it was basically the garbage rallying at the end of what was a rally, right? So I've noticed this happen. This used to happen a lot back in the early, like the 2009, 2010, 2011, when the early stages of our bull market and towards the end stages of that bear market. But a lot of times towards the end of a rally, you'd have a lot of the crap basically rally because it was the only area of the market that hadn't bounced yet. And you'll see that happen a lot of times in bear markets, and that was kind of my interpretation of what was happening when IWM was finally starting to pick up some strength, was that it was just telling us that there's really nowhere left for traders to get return, and so they're finally taking their shots at some of these riskier assets, and that has quickly changed around. IWM yesterday was down the biggest of the indices, and again today you can see down about double percentage-wise what the other indices are. 4% today, and yesterday was about the same. It was basically double what the other indices were doing. So again, it shows that once we finally start to see selling, IWM has basically picked up and led the way down. And again, if you're worried about the market, well, this is the area that gives you the best picture of where the selling is and how quickly it's going to come through. You can see we lost this March 11th level. We're already at the 50-period moving average, and more likely than not, we're going to break below the 50 and start to test this 115 to 111 area. I think at this point we could probably reappropriate this trend line. And this is what we could maybe hope for, is that we can maintain this trend. It very likely will not hold, but this would be the ideal scenario if you are really bullish this market and if you really don't want to see us correct any further. Then your hope is that this trend line holds for IWM. Because then at least show that we're still kind of making our way upwards, even if it's weaker on IWM. More likely than not, it won't hold, and we'll have to come back and retest this area around 115 or so, 116, 115. And really for me with IWM, they've already disappointed so much over the last several years that as long as they don't push new lows, then I'm okay with them. I think that the key here is just what the Dow Jones does and what the S&P 500 does. IWM has been so weak that even if they do head back to lows, it won't be a good thing, right? If we see new lows on IWM, it likely means that the Dow and the SPY are going to head back towards some of those lower levels that I pointed out that we did not want to see right away. But it doesn't necessarily mean, if we hit new lows on IWM, it doesn't necessarily mean that we're going to make new lows across the board. So, I mean, that's the one positive you could say, is they've just been so weak that even if they hit new lows, it won't lead to new lows across the board. But it definitely will mean that there's been a massive change in character in the market. So what we want to see right now is, obviously we want it to hold this trend line, but if it doesn't, which it probably won't, we don't want it to kind of lose this area around 111, 110. Hopefully we get a bounce at 115 and we don't even come down and retest down here. But once we start to lose the 111, 110 area, then it becomes almost a foregone conclusion that the price action is going to want to test
the really critical levels. So we want to kind of stay away from that point. We want some strength to kind of rotate into IWM and into the small caps, but it's a struggle right now because this is the area of the market that has really been hit hard by the shutdown orders, and it's going to be hard for a lot of these smaller cap names to really come in and step up and start to return back to normal. And so we're going to continue to see a disparity here, and so this kind of leads back to that disparity I was talking about earlier between different areas of the market. And I think the biggest kind of descriptor of that is what we're seeing in IWM versus what we're seeing in the Qs. And so, like I've said for several weeks now, if you don't want to trade individual names because you're kind of gun shy right now with the way the market is, then just focus on IWM and the Qs. Anytime you think the market's going down, just short IWM. Anytime you think the market's going to go up, you just go long the Qs. And I think as long as you pay attention to those two, and you just focus on that, you'll have a good gauge on the market, and you have a better tell, and you'll have an advantage because you'll be long the name that goes up the fastest, and you'll be short the name that goes short the fastest. Now, some people might be like, well, maybe I could take a pairs trade on that, and I think a pairs trade could work, but it wouldn't really give you the return that you'd be looking for if you could just kind of time yourself a little bit better and just kind of go in and out of these two as they head to their appropriate levels of support or resistance. And again, I think that they give you the perfect description of what's happening right now, where you have these isolated areas of the market that are either benefiting from us working from home, and those that are really getting hit hard from not being able to open up because we're at home. And that should really be, for anyone that's looking to trade and trying to figure out what stocks you want to buy or short, that should be your first thought, is especially now that we're through earnings for the most part, is really just think to yourself, is this name benefiting or being hurt by us being shut down? And even if they do open up, how long will it take for them to get back to normal? All right, so that's the markets. I think just the synopsis, I think we're still correcting. I think that we're going to sell off at least until the end of this week and beginning of next week. I think once we get to next week, we should see some buying. I mean, maybe as early as Friday, but more likely not the early part of next week is where we'll see some buying step in. And then from there, we'll see what happens, how far it could take us back up, or whether it's just a quick relief and then we try to find some support again. I feel like the market definitely had a shift in character from yesterday to today, and it is now looking for buyers, which means it's pushing down to find support levels rather than what we've seen over the last few weeks, which was the market pushing upwards looking for resistance levels. I think we found resistance, and now we're going to turn right back around and we're going to look for some support, which again is not really the end of the world. That's normally the signs of a sideways market anyway, and that's what I think we're in right now, is a sideways market. Despite what we're seeing on the Qs, I think generally speaking, most of the market is in a sideways state right now, and it should be looking to, right now, trying to figure out what the bottom of our new range is going to be. And it doesn't necessarily have to be the recent low. It could be that we establish a range with a bottom somewhere in the intermediate levels of what we've kind of retraced from March to now. All right, so real quick, I'll look at the U.S. dollar. Those of you that are in here, we have a decent amount of viewers. If you have a chart request, feel free to type it in, and I'll go ahead and get to it in a second. I don't want to spend a lot of time with the U.S. dollar right now because there's not a lot going on that's that different from what we've seen recently. The good thing with the U.S. dollar is the volatility continues to kind of slow down. You can see on the UUP index that we're starting to get a nice little bullish turn here. And it looks like the U.S. dollar wants to rally, at least as an aggregate, when we just look at the UUP index. Now, if we look at a couple of individual currency crosses, we'll see if we find the same pattern. So with the euro, this is going to be based off euros. So in this particular case, up is good for the euro and down is good. So it's kind of a mirror image of the chart we just saw. And as you can see, it looks kind of the same, where the U.S. dollar is trying to pick up some steam to push down on the euro, but the euro is actually holding up. It looks like it wants to bounce. So really, more than anything, just showing that there's a big fight going on here. And we've established a pretty decent range here between about 107.8 and maybe 109.8. And it's going back and forth between those two. And that's one of the reasons the U.S. Index has kind of been held in check a bit. Now, if we look at the U.S. versus the Canadian, we'll see a different picture, in which case the U.S. dollar continues to also trade sideways. So in that sense, very similar, but a little bit more bullish in that it looks like it wants to try to start moving upwards again. And if it can break past 141, 142, it will likely move upwards. Now that might happen towards the end of the month, as we see if we get another one of these, or not towards the end of this month, but basically towards the end of the next oil futures expiration. And if that happens, there's a good chance that if oil breaks down again, that the U.S. dollar will break upwards versus the Canadian quite strongly. Again, more than anything, range bound and kind of stuck in a tight range here as it tries to build up momentum to break outwards. And then finally, we have the U.S. versus the yen. And in this case, it's a little bit different. The U.S. dollar is actually kind of weak here. As it struggles to hold up this level here around 107, it actually failed and kind of came back. And, you know, I think, like I said, part of the reason I'm not interested with the U.S. dollar right now, there's a lot of tight ranges here, and it's kind of struggling to really find a direction. And I think that we might need to wait a little bit before we get a clear direction on it. There are some tradable ranges here, but I think I'm more comfortable right now with some going short some weaker areas of the market than I am in trading Forex. So at the moment, I'm not that interested at looking at these dollar crosses. Now, conversely, though, we do have gold, which is setting up a nice pattern here. It looks like it wants to break out. And if we see continued selling pressure in the markets and we see some selling pressure on some of the U.S. dollar crosses, we might see gold finally break out and make its way back up towards the 164 area at this recent spike that we had on April 14th. Overall, I think this is a pretty bullish pattern. It's one of the tighter patterns that gold has had in a while. You'll notice gold has been very big and very sloppy as far as how it's been trading and the range that it's been in. This is actually a pretty tight pattern, and it looks like it's setting up for a breakout. And I think the key is, will the dollar pull back on some of those levels that we were just looking at? If it does so, then that should bode well for GLD. Now, you'll notice SLV, not quite in the same place. It did break out from its own tight range, but it didn't really get a lot of upside momentum, and it's still struggling. There's been a big disparity between gold and silver right now, and I was actually reading an article about it, and it was a good point. One of the reasons that we're seeing this disparity is because, silver has industrial purposes. Obviously it's a precious metal, and it's a store of value, but, there is a decent amount of production that needs silver. Not really the case with gold. Gold is a more traditional store of value, and that's why it's done better as money has flowed into it to kind of insulate from some of these wild moves that we've seen, not only in the stock market, but even in the dollar. And so that's why gold has kind of outperformed silver. I think that our argument still holds, and I think gold is still a better purchase right now than silver if you're looking to go long. Some traders might look at SLV and be like, well, there's more room to the upside, and while that's true, I think GLD has the more of an impetus to go up right now than SLV does. So that's what I do out of those two. And then finally, the oil chart's still broken, so it's still hard to really analyze it. If we look at maybe a 30-minute chart, we can look at 30 minutes on the futures. Well, what we'll do then is we'll look at USO. And you'll see USO gives us a better picture, and you can see what's happened here. It's really struggled. It's finally at least sort of stabilized in the mid $25 barrel price. And I think the key is what happens when this next contract goes into expiration, and whether there's going to be another run for the exits like there was last month, and whether we get prices maybe not negative, but if we go back into $15, $10 barrels of oil, that's not going to just affect USO. It's going to affect the oil names, and it's going to affect the stock market. Because the longer we go without demand and the more volatile oil gets, the more it's going to affect other areas of the market. Not that excited again about going long oil. I know some people think that this is a good bargain right now. I don't think it is. I think that it's very hard to trade oil right now because instruments like USO have shown that they have some chinks in the armor based off of what happens when you have their rollover, when you have contango and super contango that affects the price and causes these ETFs to lose value. It's done better. There's been a lot of ETFs that closed down because they couldn't afford the cost anymore. USO was able to, if they did a reverse split, they changed their structure a bit to hold later months. to try to insulate themselves from that damage. But generally speaking, I'm not that I just don't want to go long these ETFs right now because there's so much systemic risk based off of the way they simulate their prices by buying oil contracts, and that leaves oil names, and a lot of oil names are struggling. And you know, even if they bounce, I feel like there are other areas of the market that will bounce more easily and will give us better trades to the long side. So again, I don't feel like the oil is a good place to go long right now, even though I think some people do. Um, but it's not my thing. All right, so let's move on to chart requests. Wes, good to see you in here. It's been a couple weeks since I see you participating. You're asking about UPS. You think that there's a head and shoulders. All right. One thing I want to point out about a head and shoulders, is a topping pattern, which means usually it occurs at the top. Now, I'm not sure. I suspect that this is what you mean here. Let's fix my trend lines. Let me know if I'm looking at the right part, Wes, but I'm assuming you're looking at this. Okay. All right, so this is what you're looking at. I would hesitate. I don't. I mean, this is not a head and shoulders in my mind because again, a head and shoulders is the type of pattern you see at the top of a range, which shows price being exhausted. Now, in this case, I understand. Maybe relatively speaking, you could say, well, it's price exhausting itself as it tries to change, and to that extent, I would say you are right, at least as far as what it's doing, right? Because it's tried. So it's like even though technically you wouldn't call it a head and shoulders, I think the price action that you're referring to is very similar, and then what you're getting is you're getting a stock that's trying to get through a price point. And I think in this case, I wouldn't necessarily call it the head and shoulders because again, first we had 2 attempts here already, and then you had this. So this would be kind of a weird thing to call a shoulder. But what I would say is that, and we'll get rid of some of these trend lines that aren't really relevant. It definitely failed at 102, right? You can see we came up, we tried to break through it, we failed. The second attempt came back, came short, and then this third attempt came up, actually breached for a bit, but then failed. And then recently, you can see the weakness come in on UPS, and it's really struggled. Now, it's interesting because you'd expect UPS to actually be doing well in this kind of environment. You know, you think about it, transportation costs are much cheaper because of oil prices, and people are ordering a lot of stuff from Amazon. So it's kind of weird that UPS is really struggling, but it is what it is. I think Amazon has used the U.S. Postal Service a lot more. Now they have their own system as you get more local, and maybe that's put a ding in their business. But you think that they'd still be doing well with the way things are going right now, and that's not the case. So I wouldn't put it as a head and shoulders, but I would say that we're in kind of a channel here, and it's really struggling to really hold along those lines. Now, the bottom of this channel is very tricky to really outline, right? Because you have these 2 candles that really shot down towards the end of March, and if we do a horizontal level, we have to basically slice through a lot of price action in order to get a level that we trust. And I think that generally speaking, we can look at this area here between about 88 and about 87 as the level of support, right? So here's the issue with UPS. I agree with you that this is not a very bullish chart, and we had a nice breakdown. And we have, if you wanted, price action was interpreted in a slightly different manner, you could say that we're already kind of getting a breakdown. If someone wanted to say, maybe say, even if they did it like this, right? We've already had a breakdown, but we're kind of getting close to the bottom of the range. So the problem here is what I outlined earlier today when we were discussing the price action in the markets about playing ranges and not wanting to break out, not wanting to buy breakouts and not wanting to sell breakdowns at the bottom, we're already pretty close to support. And I think at this point, it's likely that we're going to come back and test this level, but at that point, it probably becomes a buy the dip area. Despite the fact that this is not looking good and it's looking like it wants to head back and test lows, the risk reward's not there for a short right now. Maybe if you're in it already, then we could look at it slightly different, because again, there was a short-term entry point here yesterday, right? Because you have this breakdown, and then you have this is what I was talking about earlier as well, right? You have a break through one of these strong trend lines, and then you have a drop, and then you have a bounce to test this breakdown area, right? And when you can see it fell short, it didn't even reach the breakdown. And once we had that reversal yesterday, that becomes a nice continuation play that you play down back to the downside. Because in this case, the risk reward is very good for the short term, right? Because you can manufacture a risk reward where you say, well, I'm going to stop out if it breaks back above this wedge, because that means that my play is wrong. So you have a very tight stop here, and then you can look for a target down here around the low of that point, or even down here. So if you entered this as a short yesterday, then this is a good play. But I think at this point, the risk reward is not good, because we're looking at, what is this, about 4 points for your stop, and your target is basically 4 points, maybe even 3, right? So at this point, it's not a good trade to the downside, and it's not really a good trade to the upside because of the price pattern that we're seeing here. So that would be my thoughts on it, Wes. I think that if you already shorted it, whether you shorted it at the breakdown of this trend line or the short down of this, then you have a trade that's working pretty well. But at this point, looking at it as a potential trade candidate, I don't think it's a good trade candidate right now, because the risk reward is not good to the downside where it is right now. Because I wouldn't expect price to really breach 88, at least not initially. It might eventually make it through there, but not where it is right now. So even though I do think it's going to go down another 4 points, I don't know that it makes a good trade at this point. Oh, okay. So if you're looking to buy it and you're trying to avoid a bearish pattern, then I think what you want to do is, so 88 is where you want to buy it, but you don't want to just buy it when it hits 88. You want to see a change in character, and you want to see a bullish candle pattern here. It doesn't have to be a major, triangle or an inverse head and shoulders. It could just be that you see a bullish engulfing pattern after a couple of hammers or something like that. At that point, you could trust the range and look for it to go back to the long side. I think ultimately, if you see the market stabilize next week, there's a good chance that UPS will be attempting to stabilize somewhere around this 88 level. And that's where you could look for it to go ahead and bounce now. That's what I would do on this name. Okay? Alright, so if anyone else has a chart request, feel free to add it. I'm going to put in here, so just give you guys an idea of what I was looking at. So I think REITs have struggled, real estate investment trusts. And so this was my trade idea from Monday. Again, a market that I thought has a pretty big divide here between strength and weakness. And as you can see, you can look at NLY here. It doesn't look very, very good when you compare it to what we saw with some of these tech names, right? And so this is a good idea of how I would look at it. Again, the risk reward, you're looking at you've got maybe a 50-cent stop, and you've got a target of probably about $1, and then possibly down here to about $1.50, $2, right? So that's kind of what I was looking for. You can see the price pattern. You can see what we're looking for here as far as how to go ahead and trade. The other one we were looking at was, again, an oil name, which again I think oil is doing poorly. And you can see we had the trigger, and it's actually doing better from a bullish standpoint, so not quite as good a short for us right now. You can see, there's still strength in oil, and this name is not going to break down probably as quickly, but I think as we move forward into the end of the month and we start to see oil, and we start to see if oil prices drop, that some of these names might start to hit a little bit further down. And I think that this level here was a really strong level of resistance and becomes a really good point that I think oil is not really, this WPX is not really ready to breach, because I think oil has a lot of weakness coming in the next few weeks. So those are the two names that I was looking at. If you want to look at how I'm participating in the market, and what exactly I'm looking for that coincides with what I'm describing in these Wednesday market streams. So those are my ideas. Now, I also tweeted, for those of you that maybe just follow me on Twitter, how financials also look weak, right? So you take a look at XLF, and you can see what I pointed out yesterday, and you can see the weakness. And again, this is that pattern again, right? You get a break of this trend line, and then you get a retest of that breakdown point. And you can see XLF tested it a few times. You had the moving averages come in, and then you have that rollover in price action, and you have that breakdown. And you have, and at this point, you can see it's starting to really move to the downside, and we'll see exactly where buyers step in. But again, showing weakness in a certain area of the market that is really, starting to struggle. I had someone ask me what I mean when I say rollover. I think this is the perfect example. It's imagine a ball rolling over a table, right? So when price action rolls over, look at the moving averages, how they start to roll right back over and start heading back to the downside after, initially starting to move back up. And that's what I mean by price action rolling over, is the price action is looking to stabilize and looking to go up or sideways, and then all of a sudden you get this drop. And in this case, I think financials again have been showing weakness for a few weeks now. You can see they already breached that, they broke that downtrend a while ago, and are only now starting to really start to show more signs of weakness coming in. And it's another area that I think is good to watch. Another chart that I looked at and mentioned yesterday on StockTwits was AXP, American Express. Someone had asked me a chart request on this, and again, you can see very similar to XLF, kind of struggling here. All right, Ray, you want to look at XLK. Oh, by the way, Ray, good to see you in here. So you were asking, I just want to go ahead and point something out real quick. On email, you were telling me how, why I didn't like your Merck trade, that you thought that you were like, well, my Merck is up and my UNG's down, and you like UNG. And so this is why, a lot of times I can't analyze your actual positions, like your puts, because I don't know your entries and I don't know what prices you get. But this is why I like the UNG play. If you look at UNG where it is now, that's why I said I like the short on UNG, was because in my mind UNG had a lot of potential to the downside, right? And so I would think by now whatever short play you had on UNG is up positive, even if on Wednesday it wasn't working for you. I don't know what your entry was when you entered, but at this point it has to be up, right? And then the other one you were pointing out was Merck, and you were like, well, this is a good short. I don't know why you like it, and this is why I didn't like it, is because more likely than not, it was going to get stuck at this level. And you can see, maybe your trade is still working, maybe it's not, but this is why I don't like to buy, or I don't like to short at resistance levels, because it was already down so many days in a row, and now it's kind of stuck. So I just wanted to go ahead and give you an idea why I liked one trade and why I didn't like the other, and what's happened in the week since we last talked. And as you can see, UNG made its way back to the bottom of the range, and you can see Merck has been stuck at this very tight range for a week now. Okay, and so a lot of times when I look at your guys' chart requests, I don't have enough time. So for instance, your XLK here, you have a put. You have an 80 put at 87 cents, and it's now up to $1.17, $1.20. So when I look at these, it's harder for me to sometimes analyze them based off the chart. So now in this case, you exited Merck at break even, and you exited UNG this morning. Okay, good. So now in this case, I remember last week we talked about or 2 weeks ago, and I didn't like the trade, right? And I didn't like the trade because, again, you were shorting the tech sector, and this trade has worked in your favor, but I still didn't like the trade because you were shorting the strongest area in the market, and I think that there's a chance that you would have gotten a better move on a weaker area. Okay. Now that being said, the trade is up for you. You bought it at 87, and it's now trading at about $1.17, $1.20. So you're up about maybe 25-30%. I would say at this point, I I don't know how many. If you only bought one, then I don't know. You don't really have much of a choice. I think that, like I said, with the overall markets, there's a chance that we go down another day or two. So there's a chance that you can get more profits out of this. I would watch how we close today. If we bounce at the close and this thing is back at the top of this trend line, you might want to just take your profits. However, if we close at the lows, then maybe wait for tomorrow. And if we have a nice gap down, then you can go ahead and take your profits. Again, I think that this is a stock that. Oh, this is a new trade from this morning. Okay, so I'm assuming the other trade, it was like a week or 2 weeks ago, so it probably lost for you. So new trade this morning. I think again you picked the wrong area. You could have shorted IWM, and IWM again was down 3-4% today. And the tech sector is only down 2% today, right? So what I told you before, I think still stands. I think you're picking the wrong area of this market to short. Now, when we have a market correcting, everything's going to go down. So, whether you pick this, whether you pick XLF, whether you pick IWM, whether you pick the Qs, everything's going to go down on days like today, right? But can you get a better return trading a different ETF? Probably. Okay? And that's what I mentioned before, and I don't know how come you went ahead and did the same thing. But there are areas of the market that are they're weaker. And you're probably better off getting shorts on those than you are shorts on the strongest area of the market. And that would just be my advice. Okay. Now that being said, it's up. I mean, your trade's up right now, and this is a nice candle. And if you can get another move down tomorrow, I would probably look to take profits on this trade tomorrow. I would imagine we get at least one more day down. We'll see how we close today, but I think that there's a decent chance that we do get a little bit more selling. Okay. All right, Wes, have I been paying attention to? No, I have not. VTIQ. No, I don't even know what Nikola Motors is. What is that? Is that? Oh my! Look at this. No, Wes, I have not paid attention to this. So what's the story with this? I'm gonna put this. Oh, so that one doesn't show up. Okay, so new fuel cell electric car company. No, you know what? I didn't pay attention. So is this VTIQ? I guess is the ones that are going to try to acquire them, or they already acquired them. Oh, the ticker's going to change. Okay. No, I did not know. Oh, so new Tesla basically. No, I'm going to have to do some research on this. That is a nice chart. It's on my watch list now. That's impressive. That's actually pretty nice. I'll have to keep an eye on them. Now, obviously, at this point, you can't really trade this, right? So this trades a little bit, at the moment, a lot of biotechs trade like this, and this is actually how a lot of those weed names traded back in the past. When you have names like this that trade off of news, they tend to get these big moves, and then they just kind of die down. And then eventually news comes in, and they really spike, right? So you'll see a lot of these patterns. Big move up, and then big move up, and then big move up. So it's probably going to die down, and it's probably going to make its way back into the 20s or into the teens. And then from there, as it dies down, you'll have to wait for the next news event. At that point, it looks like it'll be a good buy. But obviously, at this point, it's pretty strong to the upside. Someone might want to short this, but I wouldn't short this. With this kind of strength, you never know how far it's going to explode to the upside. So unless you're day trading, it's probably not these aren't the kind of names that I like to short, personally. There is a style of trading that likes to short it, but that's not my thing. But no, Wes, thank you that you just added a new name to my watch list and something for me to look at and to research as once we finish today's session. That's pretty impressive. it reminds me, not the same thing, but I also was looking at this yesterday. This is a name that I've been long since March, and it's had an explosive move, D-Dog. Then this again, it's not related at all to electric cars, but just one of the, just showing there has been explosions to the upside in this market, and you have to find these areas that benefit from people staying at home, whether it's a cloud stock or other stuff. You have names like this, like D-Dog. You have like Team, that they're at new highs because there are names that benefit from what's going on right now, and there are names that are the future. And you might look at it something like like what Wes just pointed out, or like these names. You might say, well, yeah, but they're doing good now because of where the market is, but no, these names are the future. This was a trend that was happening before we got shut down. There was already a lot of people that were working from home, 1 or 2 days a week in a lot of corporations. That's been a trend that's been going on for several years now, and it's a trend that will continue. I think we saw Twitter said that its workers can indefinitely work from home. Even once things come back, they can work from home forever. Because you'll see that it benefits companies as well as workers, because it's less real estate that they have to have to keep, and it's easier in a lot of ways now. Yeah, sometimes you have less supervision, but nowadays everything's online anyway. So for those of you that maybe are struggling in this market, there are pockets of strength. There are areas, there are names like this that you can find, and you just have to understand what kind of scenario we're in, and what's working and what isn't working, and don't try to reinvent the wheel. Don't try to do things that don't try to go opposite the grain just because you want to be different. There's a very good reason for why some things in the market are working and some things are not, and you're better off kind of riding that wave rather than trying to do your own thing. Okay? So that covers it for today. Thank you, Wes, and thank you, Ray, for giving me some stocks to look at, and names that I could put on my watch list to watch in the near future. Everyone else, thank you for watching. If you have a chart request and you didn't get to ask, or you felt nervous about asking in public, you can always ask me. You can message me on StockTwits or on Twitter, and I could DM it to you or just send it public, or you can email me. I'd be more than happy to go ahead and give you your chart request that way. Again, if you like what you see here, you can visit me at patreon.com/StockDarts. You can find more of my trade ideas on there, and more of my thoughts on how I go ahead and approach this market. Okay? Other than that, hope you guys have a good rest of today and rest of this week, and we'll meet again next Wednesday.